What if I told you that choosing the wrong dividend ETF today could cost you almost $800,000 in retirement? That's nearly $1 million gone. And here's the catch. The two ETFs everyone is flocking to, SCHD and VIG, already control over $130 billion combined. They both look safe, they both look strong, and for income investors, they both promise yield and growth. But dig a little deeper, and the differences between them could decide whether you retire comfortably or spend decades playing catch-up. Today, we're putting two of the biggest dividend ETFs in the ring, SCHD versus VIG. On the surface, they look similar, but under the hood, they're completely different species, built on opposite strategies. We'll break down how they choose their stocks, which industries they really bet on, and why their performance can look so different. And stick around, because by the end, you'll know exactly which ETF could give you the edge in 2025, and which one might quietly hold you back. When you peel back the ticker symbols, SCHD and VIG follow completely different rulebooks. Let's start with SCHD. It tracks the Dow Jones US Dividend 100 Index, which is like an exclusive club with some strict entry requirements. Companies must have at least 10 years of dividend payments, a market cap over $500 million, and enough liquidity to trade easily. But that's just a door test. Once inside, each company gets graded on things like cash flow compared to debt, return on equity, dividend yield, and 5-year dividend growth. From there, the index limits any single stock to 4% and any sector to 25%. Noticeably missing? REITs, MLPs, and BDCs. So this is strictly corporate equities. Translation: SCHD is basically the top 100 US companies that not only pay dividends, but prove they can keep paying them. The design is simple. Give investors a bigger paycheck today, backed by financially strong businesses you don't lose sleep over. Now compare that with VIG. VIG tracks the S&P US Dividend Growers Index, and it plays a completely different game. Instead of hunting for yield, it looks for companies that have grown their dividend for at least 10 straight years. In fact, it automatically excludes the top 25% highest yielding firms to avoid potential yield traps. Unlike SCHD, it doesn't enforce a minimum dividend yield or payout ratio. Simply put, VIG is built for dividend growth momentum, not maximum yield. It's betting on consistent growers, not today's biggest payers. And here's where it gets interesting. These rulebooks create totally different portfolios. So how does that show up in their holdings and industry exposure? Let's dive in. Now let's go deeper. One of the clearest differences between SCHD and VIG is in their industry exposure. And this isn't just trivia. Sector tilts can make or break your portfolio when markets shift. Start with SCHD. Its allocation is more balanced and defensive, but with one massive tilt: energy. Nearly 20% of SCHD sits in giants like Chevron and ConocoPhillips. That's huge. When oil and gas are booming, SCHD gets a tailwind, but when energy slumps, it can drag the fund down. Outside of that, SCHD leans on consumer staples at nearly 19%. Think Pepsi and Coca-Cola, and healthcare around 15%, with AbbVie and Merck. These are the recession-proof sectors. People keep buying food, medicine, and household products no matter what. In short, SCHD is tilted toward dividend-rich, old-school value. Now flip to VIG. Its DNA is completely different. Instead of staples and energy, it loads up on technology at 27%, Microsoft, Apple, Broadcom, and financials at 23%, names like JP Morgan, Visa, MasterCard. Then about 15% in healthcare with Eli Lilly. The upside? Huge growth potential. These are the companies driving the US economy forward. But the trade-off? Tech-heavy portfolios can get hit hard when interest rates rise or growth stocks fall out of favor. So here's the story in plain English. SCHD is the income defensive ETF, built on staples, healthcare, and energy. VIG is the growth defensive ETF, betting on tech and financials. Now here's a fascinating twist. Despite their different tilts, both ETFs are surprisingly calm. Their beta, basically their volatility compared to the S&P 500, sits under 0.9. Translation, they're both less volatile than the market as a whole. Dividend payers tend to be mature, profitable, and stable. Plus, those dividends can be reinvested when prices dip, giving you more shares for the rebound. But there's another difference: concentration. SCHD is top-heavy. Its top 10 stocks make up 41% of the fund. So when Chevron or Pepsi moves, you feel it. VIG's top 10 is about 33%, spread across 300-plus companies, making it more diversified by design. And here's the kicker: there's zero overlap between their top 10 holdings. SCHD's big bets, like Chevron, Pepsi, and AbbVie, don't show up in VIG. And VIG's giants, like Microsoft, Apple, and JP Morgan, don't appear in SCHD. That means if you hold both, you're not doubling down. You're actually diversifying across two very different groups of dividend payers. One side gives you income and defense. The other side gives you growth and compounding power. So remember this: both ETFs offer stability, but in totally different ways. SCHD is defensive, with big energy exposure that can either supercharge or sink performance. VIG is diversified, tilted toward the future economy, tech, and financials, but tied closer to market cycles like the S&P 500. So which one actually comes out on top for 2025? Let's break it down next. So who's the real winner for 2025 and beyond? Let's put this battle to the test. Starting with SCHD. The dividend yield is nearly 3.8%, double the S&P 500 and more than twice VIG's. Its dividends have been growing around 7% per year, while the share price has climbed about 9% annually. Translation: SCHD isn't just about income, it's a total return machine that throws off reliable cash flow along the way. Now, VIG. The yield is smaller at 1.6%, but don't count it out. Dividend growth is faster, over 8% per year, and the share price appreciation is even stronger at nearly 12% annually. Over the past decade, VIG has inched ahead with an 11.5% annualized return versus 11.3% for SCHD. Not exactly a knockout punch, but enough to attract more investor money, about $79 billion compared to SCHD's $56 billion. But here's the twist: that extra edge in growth comes with more pain in the bad times. VIG's worst drawdown? Nearly 47%. SCHD's? Closer to 33%. That's a huge difference when markets turn ugly. Pair that with SCHD's higher dividends, and suddenly SCHD looks like the safer, more comforting paycheck. So how does this play out long term? Imagine you invest $100,000 today. With SCHD, after 10 years, you'd have around $12,500 in dividends, and a portfolio worth $337,000. After 20 years, those dividends climb past $48,000 a year, with a portfolio of $1.18 million. Fast forward 30 years, SCHD pays you nearly $16,000 per month in dividends, and your portfolio tops $4.3 million. Now compare VIG. After 10 years, dividends are smaller, about $6,200, but the portfolio value is higher at $356,000. By 20 years, dividends reach $28,000 per year, with a portfolio of $1.32 million. And by 30 years, dividends hit around $11,000 per month, much less than SCHD, but the portfolio grows to over $5 million, about $800,000 more than SCHD. So here's the bottom line. SCHD clearly wins on income today, while VIG wins on wealth tomorrow. It's not about which ETF is objectively better. It's about which future you care about more. Do you want the bigger paycheck now, or the bigger nest egg later? So which ETF is right for you, SCHD or VIG? The truth is, there's no single knockout winner. It comes down to your goals and your timeline. If income today is what matters most, SCHD is your partner. A higher yield, steady cash flow, and less exposure to the mega-cap tech names that already dominate the S&P 500. For investors looking at a shorter runway, say the next 5 to 10 years, SCHD gives you that balance of growth and dependable paychecks. If your focus is long-term wealth, then VIG takes the crown. You'll sacrifice yield in the short run, but in return, you're stacking faster dividend growth and stronger compounding over time. Perfect for investors with 10-plus year horizons who want to quietly build a larger nest egg. And here's the best part, you don't even have to pick just one. Since their top holdings don't overlap, combining SCHD and VIG actually expands your diversification, giving you both today's income and tomorrow's growth. So here's the takeaway. The best dividend ETF for 2025 isn't one size fits all. If you want bigger paychecks sooner, SCHD has your back. If you're playing the long game, VIG quietly compounds into the future. And if you want the best of both worlds, owning both actually boosts your diversification and balances income with growth. Which path are you taking? Income today, wealth tomorrow, or both? Let me know in the comments. And if you want more ETF strategies, tap the video on your screen. The next one could change how you invest.